What if I told you there's a way to invest $5,000 and get $10,000 worth of exposure? Not through gambling, not through risky margin trading, through two brand new ETFs that just launched in January 2026. Most investors think you have to choose. Gold or Bitcoin, stocks or crypto, growth or income. But what if you didn't have to choose at all? What if you could have both at the same time while collecting weekly paychecks? Let me show you exactly how this works. My name is Richard, and I teach what schools never taught us about investing. Here's something nobody talks about. Weekly dividend ETFs have a dirty secret. They pay you every week. That sounds amazing, right? But here's the catch. While they're paying you, your account balance is shrinking. It's like getting a raise at work while your savings account slowly drains. You feel rich for a moment, then you check your balance 6 months later and realize you're actually poorer than when you started. This is called NAV erosion, net asset value erosion. It's killed more retirement dreams than market crashes. But two new ETFs from a company called Quantify Funds claim they've solved this problem, ISBG and ISSB. Those are the ticker symbols. They promise weekly income plus account growth, not one or the other, both. I've spent the past month digging into these funds, reading the prospectus, analyzing the structure, comparing them to every other weekly dividend ETF on the market. Today, I'm going to show you exactly how they work, who should consider them, and who should stay far away. Because here's the truth. These ETFs are either the smartest innovation in income investing I've seen in years, or they're a leverage trap dressed up in clever marketing. Let's find out which one. First question, why would anyone want gold and Bitcoin in the same investment? Well, here's a question most investors struggle with. Should you buy gold or should you buy Bitcoin? Gold is safe, boring, steady. It's been valuable for 5,000 years. Bitcoin is wild, exciting, volatile. It could 10 times, or it could drop 50% next week. Most financial advisors tell you to pick one. Maybe split the difference. Put half in gold, half in Bitcoin. But there's a problem with that approach. Let me show you. You have $10,000 to invest. You put $5,000 in gold. You put $5,000 in Bitcoin. You now have exposure to both. That's diversification. That's smart, right? Sure. But here's what nobody tells you. You've also limited yourself. You can only gain or lose based on $5,000 in each asset. If gold goes up 20%, you make $1,000. If Bitcoin goes up 30%, you make $1,500. Your total gain is $2,500 on a $10,000 investment. That's a 25% return. Not bad. But what if I told you there's a way to get the same exposure with only $5,000? What if you could invest $5,000 and get $5,000 worth of gold and $5,000 worth of Bitcoin? That's not magic. That's called stacked exposure, and it's exactly what ISBG does. Think of it like this. Traditional investing is like building a house on a single lot. You can only build so big because you only have one piece of land. Stacked exposure is like building up instead of out. You're using the same lot, but you're building a 2-story house instead of a 1-story house. Same amount of land, double the space, same amount of money, double the exposure. Now, here's why gold and Bitcoin together actually makes sense. They move differently. In 2025, gold hit all-time highs. Bitcoin crashed 40% from its peak. If you owned just Bitcoin, you were panicking. If you owned just gold, you missed the Bitcoin dip, the buying opportunity of the year. But if you owned both through a fund like ISBG, the fund automatically sold gold at the top and bought Bitcoin at the discount. You didn't have to do anything. The fund did it for you. That's the power of combining assets that move in different directions. And here's the part most investors miss. Gold isn't just safe. It's an insurance policy against Bitcoin. Bitcoin isn't just risky. It's a growth engine that gold can't provide. Together, they balance each other. When one zigs, the other zags. And the fund rebalances automatically, forcing you to buy low and sell high even when your emotions are screaming at you to do the opposite. Now the same logic applies to ISSB. That's the other ETF. Instead of gold and Bitcoin, it's the S&P 500 in Bitcoin. Same stacked exposure concept. $5,000 gets you $5,000 in stocks and $5,000 in Bitcoin. But here's why this combination might be even smarter for most people. The S&P 500 has been the most reliable wealth-building machine in history. It's up over 15% in the past year. Bitcoin is the wild card, the speculative bet that could multiply your returns. Together, you get the stability of America's 500 biggest companies and the upside potential of crypto, all in one ETF, all with weekly income. But wait, How do these ETFs pay you every week without destroying your account balance like every other high-yield ETF? That's the billion-dollar question. Let me show you the strategy that changes everything. Okay, here's where most weekly dividend ETFs go wrong. They use something called covered calls. Let me explain this in the simplest way possible. Imagine you own a car worth $20,000. Someone offers you $200 a month to have the option to buy your car for $22,000 anytime in the next year. You take the deal. Easy $200 a month, right? But here's the catch. If your car's value goes up to $30,000, that person exercises their option. They buy it for $22,000. You just missed out on $8,000 of profit. That's a covered call. You get steady income, but you cap your upside. This is exactly how most weekly dividend ETFs work. They own Bitcoin, or stocks, or whatever. They sell covered calls on those assets to generate income. You get paid every week. Feels great. But when the asset skyrockets, your ETF barely moves, because the fund sold away the gains to pay you those weekly dividends. Over time, your account balance shrinks, even if the underlying asset is going up. That's NAV erosion. It's slow, quiet, deadly. Most investors don't even notice until a year later when they realize their $10,000 account is now worth $8,500. Even though they collected $1,500 in dividends, you broke even, but you didn't actually grow wealth. So how do SBG and ISSB avoid this trap? They use a completely different option strategy. Here's the key difference. Traditional covered call funds sell short-term options right at the current price. That's how they cap your gains. Quantify Funds does something smarter. They buy long options that expire 3 to 18 months out. These are called flex calls. Think of these as your growth engine. These capture most of the price appreciation when Bitcoin or gold or the S&P 500 goes up. Then separately, they sell short options that expire in 1 to 180 days, usually much shorter than the long options. These short options generate the weekly income, but because they're structured differently, they don't kill your upside the same way traditional covered calls do. Here's the genius part. The fund's primary goal isn't to maximize your weekly paycheck. It's to maximize your total return. That means account growth plus income, not one or the other, both. This is the opposite of how most high-yield ETFs work. Most high-yield funds will drain your account to maintain a fat distribution. They don't care if your principal shrinks. Quantify explicitly says, our goal is positive total return. They want your account to grow even while you're collecting weekly income. Let me give you a real example from their growth fund, BTGD. BTGD is the non-income version of ISBG. Same gold and Bitcoin exposure, but no weekly distributions. In late 2025, Bitcoin crashed over 40% from its peak. If you owned just Bitcoin, you were down 40%. But BTGD, only down to where it showed it was still a P 45.5% overall. Not down, up. Why? Because gold kept rising and the fund rebalanced between them. Even though Bitcoin got destroyed, the fund stayed in positive territory because of the gold exposure. Think of it like this. A traditional covered call fund is like a car that trades horsepower for fuel efficiency. You get great gas mileage, but you can't accelerate. ISBG and ISSB are like a hybrid. You get decent fuel efficiency, and you can still accelerate when you need to. You sacrifice a little bit on both sides, but you get balance. Now, here's the cost. Both funds charge 1.14% in annual fees. That sounds high, and it is. Most index funds charge 0.03% to 0.20%, but here's why it's not crazy. You're paying for active management, options trading, rebalancing, leverage management. If the fund delivers on its promise, weekly income without destroying your principal, that 1.14% is worth it. If it doesn't, then you're just paying 1.14% to watch your money slowly disappear. That's the bet. But there's one more piece to this puzzle, and it's the part that most investors completely misunderstand. How does the fund force you to buy low and sell high automatically without you lifting a finger? This is where the magic happens. Let me ask you a question. When was the last time you sold an investment when it was up 50%? Most people can't do it. They hold. They think, it might go higher. And when was the last time you bought more of an investment after it crashed 30%? Most people can't do that either. They panic. They think, what if it crashes more? This is human nature. We hold winners too long. We sell losers too early. Even professional investors do this. But ISBG and ISSB don't have emotions. They're forced, by design, to do the opposite of what humans do. Let me show you exactly how this works. Remember, these funds maintain stacked exposure. That means 100% exposure to Bitcoin and 100% exposure to gold, or S&P 500. In dollar terms, that's a 50-50 balance. If you have $10,000 in the fund, $5,000 worth of exposure is in Bitcoin, and $5,000 worth is in gold. That balance must be maintained. Now here's what happens when prices change. Let's say gold goes up 30%. Bitcoin drops 20%. Your gold exposure is now worth $6,500. Your Bitcoin exposure is now worth $4,000. The balance is broken. It's no longer 50-50. So what does the fund do? It sells some gold, it buys more Bitcoin, it doesn't ask your permission, it doesn't check the news, it doesn't wait for Bitcoin to find a bottom, it just does it. It sells gold at $6,500 at the top. It buys Bitcoin at $4,000 at a discount. It rebalances back to 50-50. This exact scenario happened in late 2025. Gold hit all-time highs, Bitcoin crashed. If you owned them separately, you'd be staring at your portfolio thinking, should I sell my gold? Should I buy more Bitcoin? What if Bitcoin drops more? What if gold keeps going? You'd freeze, most people do, but the fund didn't freeze. It sold gold at record highs. It bought Bitcoin at multi-month lows. 6 weeks later, Bitcoin bounced 15%. Gold pulled back 5%. The fund automatically sold Bitcoin near the bounce, bought more gold on the dip. It did the exact right thing twice, and you didn't have to make a single decision. Think of this like autopilot on a Tesla. You're still in the car, you're still in control, but the car is handling the second-to-second corrections that you'd mess up if you tried to do them manually. The fund is doing the same thing with your investments. It's executing a proven strategy, buy low, sell high, that almost no human can actually do consistently. I've been investing for over a decade. You know how many times I've perfectly timed a rebalance? Maybe twice. You know how many times I've told myself I should rebalance and then didn't do it because I was busy or scared or convinced I should wait? Dozens of times. Automation beats discipline every time because automation doesn't get tired. It doesn't get scared. It doesn't check Twitter before making a decision. It just executes the plan. Now here's the important part most people miss. This rebalancing isn't free. When Bitcoin crashes 40% and gold rises 20%, the fund is still exposed to that Bitcoin crash. You don't avoid the pain, but you do avoid the panic. Because while Bitcoin is down, gold is up. The fund automatically shifts between them, and you end up with a smoother ride than if you owned Bitcoin alone. Look at the BTGD example again. Bitcoin down 40%, BTGD still up 45% overall. That's the power of rebalancing between uncorrelated assets. This all sounds incredible, right? Stacked exposure, weekly income, automatic rebalancing, total return focus. So what's the catch? Because there's always a catch. And if you don't understand the risks, you could lose a lot of money. Let me show you what could go wrong. Okay, real talk time. Everything I just explained sounds amazing. And honestly, it is impressive. But these ETFs are not a free lunch. There are 3 major risks you need to understand before you invest a single dollar. Let's go through them one by one. Remember how I said you get double the exposure with the same capital? That's awesome when things go up, but it's brutal when things go down. Let me give you a nightmare scenario. It's 2026. A major financial crisis hits. Bitcoin crashes 25%. Gold crashes 15%. With 200% stacked exposure, you don't lose 20%, which is the average of 25% and 15%. You lose closer to 40%. Because you have double exposure to both. When both assets fall at the same time, leverage amplifies the pain. Think of leverage like an amplifier for a guitar. When you play a beautiful chord, the amplifier makes it sound amazing. But when you hit a wrong note, the amplifier makes it sound awful. Leverage amplifies everything, good and bad. Now to be fair, gold and Bitcoin usually don't crash together, they're uncorrelated, but usually isn't the same as always. In a true panic, a 2008-style crisis, everything can sell off at once. And if that happens, 200% exposure means 200% pain. Here's something Quantify admits in their paperwork. Weekly distributions are not guaranteed. They can fluctuate, they can shrink, they can disappear entirely. Why? Because the income comes from selling options. And options premiums depend on volatility. When markets are wild and crazy, options are expensive. The fund can sell them for high premiums. You get bigger distributions. When markets are calm and boring, options are cheap. If the fund can't generate much income, your distributions shrink. So if you're counting on a specific dollar amount every week to pay your bills, these ETFs are not for you. The income is variable, always. I learned this the hard way with another options-based ETF a few years ago. I was getting $150 a month in distributions every month, like clockwork. Then volatility dried up. My distributions dropped to $80 a month. Then $50. Then some months I got nothing. The ETF didn't lie to me. It never promised consistent payments, but I assumed it would keep paying. That assumption cost me. Don't make the same mistake. Both ISBG and ISSB launched in January 2026. As of now, they each have less than $2 million in total assets. That's tiny! For comparison, popular ETFs like SPY have over $400 billion. Why does this matter? 3 reasons. 1. Liquidity. With low assets, there aren't many buyers and sellers. That means wider bid-ask spreads. You might pay more to buy and get less when you sell. 2. Delisting risk. If these funds don't attract enough investors, Quantify might shut them down. You won't lose your money, but you'll be forced to sell and figure out a new strategy. 3. Unproven track record. These funds are 8 weeks old as I'm recording this. We have no idea how they'll perform over a full market cycle. They might be brilliant. They might be disasters. Time will tell. So here's my rule. These are not core holdings. I don't care how smart the strategy sounds. You should not put 50% of your portfolio in ISBG or ISSB. Think of your portfolio like a basketball team. Your core holdings like VOO or VTI are your starting 5. They play every game. They're reliable. They're boring. ETFs like ISBG and ISSB, they're your bench players. You use them in specific situations, but they're not running your offense. My personal rule, no more than 5% to 10% of my portfolio in any single leveraged or options-based ETF. Maybe less if I'm close to retirement. Keep the bulk of your money in simple, boring index funds. Use these as tactical tools, not as your foundation. All right, we've covered the good, we've covered the bad. So what's the final verdict? Are these actually the best weekly ETFs of 2026? Let me give you my honest answer. Here's the truth. I can't tell you if these are the best weekly ETFs of 2026, because it's only February. We're 4 weeks into the year, but I can tell you this. ISBG and ISSB are different from anything else I've seen in the weekly dividend space. They're not just chasing yield. They're not selling covered calls at the current price and capping your upside. They're actually trying to grow your account while paying you weekly income. That's rare. Now I want to hear from you. Which combination sounds more interesting? Gold and Bitcoin through ISBG or S&P 500 and Bitcoin through ISSB? Drop a comment and tell me your thinking. And if you want me to compare these to other weekly dividend ETFs like XDTE, QDTE, or SVOL, let me know. I'll make a full breakdown video.